Good afternoon, everybody. Welcome to Trader Merlin Show for your Thursday afternoon edition. A little bit of a special show today because it's going to be kind of a targeted project from a viewer. It was a question that came through. Sorry for the disheveled hair over here. But anyway, interesting trading day. Hope you all did well. We'll talk about markets at the end of this. Just so you guys know, don't try to draw me into an hour show today. I have a dentist appointment at 3 p.m., so I'm going to need to wrap this up in 45 minutes or less. All right, let me dive into the topic du jour. Now, many of you are probably familiar with this topic, as I believe you're a lot of long-term investors here. But the question was, essentially, if I break everything down, the question boiled down to dollar cost averaging for the long haul, which is what the topic of today's show is. So let me dive into a summarized question here from Darcy up in Vancouver. And Darcy, thank you for sending in the question. Thank you for listening to the show. I appreciate the support and the comments you sent in. Great to have our neighbors to the north, even though you're not in the U.S., still love the fact you watch the show. Financial markets are universal, absolutely universal. So there's three different questions kind of brought in here, and I broke it up into three different talk points on this topic. His first one says, essentially, is dollar cost averaging into a global equity ETF like XEQT the right long-term strategy for somebody starting at 45? I've committed $150 every 2 weeks to dollar cost average into XEQT. Okay, so congrats. And for those, I'll give you some little background here. Darcy was also mentioning that they tried to day trade a little bit, short-term trading, just lost some money and found out it really wasn't for them, which I think is kind of common. I think a lot of people get enamored with this idea of I can get in, get out, make some money real quick, and then just run away and have all these nice profits. So I think that may have been what happened in the past here with Darcy, and he's like, look, I'm done with it. I am now going to be moving forward and just saying I'll go long-term investment. Okay, I like that. I think everybody should have at least some of their portfolio in a long-term investment approach, whether that's a 401k or an IRA in the United States or whatever the account numbers are in international markets. Think for the long haul, I think, is definitely important. Now, if you are investing for the long haul, there's a couple things you need to consider. So in this, you specifically point out this XEQT. So I'm going to have some placeholder slides here. First off, if you are going to be dollar cost averaging, I want you to start thinking about what exactly you are invested in. And it's important because in your case, when we break it down, you'll see it's actually a fairly decent investment vehicle, but there are some red flags with it, which I will present here shortly. Always research what you're buying. And this is the sad reality. Many people, even those who are astute investors that are watching this show right now, you probably don't know exactly what your 401k is invested in, right? Every month, your paycheck or every bi-weekly, your paycheck takes money out, throws it in a 401k, and you've picked some funds, but you probably can't even remember what those funds are, and most likely you don't know what they're holding. So I did a little work here. I didn't have a lot of time today as I was working. I did some presentations this morning for a charitable organization, which I had a lot of fun. Thank you, Thomasina, for that. But here is the breakdown of what XEQT is. Now, this is kind of uncommon. XEQT, normally an ETF like this is going to target a specific market. What XEQT does, just from digging a little bit, is it breaks this down into 5 separate investments. And they're basically all iShares products. So this is a very clever way for BlackRock, which is the owner of iShares, to just buy more of their products. So what they've done is they've created a Canadian product called XEQT, and in that is bundled the iShares Core MSCI EAFE IMI Index. That's a whole mouthful of words there, basically saying this is an international stock fund. So it's going to have equities from around the world, and that makes up 25.3% of that portfolio. Making up, rounding up here to 22%, you have the iShares Core S&P Total U.S. Stock Market ETF. Now, let me ask you guys a simple question. Do you think that if you take the S&P 500, the total U.S. stock market, you know you're going to get Microsoft and Amazon and Intel and the big names, right? The Magnificent Seven are all in there. Do you think that those Magnificent Seven are also going to be in this international index? Because this international one isn't just international. It has some U.S. stuff in there too, most likely the big participants. So you've already got a little bit of double up here on these ETF. You have overlap. And now you look at the third line here. This is the iShares Core S&P Total U.S. Stock Market Index ETF. You are going to get more overlap. Yep, U.S. is absolutely international. So there's almost 21% is in that S&P total U.S. stock market index. Again, more overlap, pretty much the same thing as the line item above it, in my opinion. Now, you've got the iShares Core S&P TSX, that's Toronto Stock Exchange, Capped Composite Index ETF. Again, more overlap. That's 26.75% of the portfolio. And then down at the bottom, you have 5.35% in the iShares Emerging Markets. So essentially what you have here is something that is heavily, heavily weighted towards U.S. equities, most likely the largest big playing, Magnificent Seven stocks. So you are getting a lot of tech exposure here with a smattering of international, right? Is this necessarily a bad thing? No, not really, but at least it's a framework for us to start looking at and saying, what are the risks here? The risks are that you're 100% equities. Now, again, that's not necessarily a bad thing, not necessarily a good thing, and I'll explain why when we get to portfolio construction and allocation here in just a little bit. So far, I would say this one's okay. Now, the other piece you have to think about with these things like XEQT or whatever fund you're buying into are what are the fees? This is something that for those of you that have 401ks, you really should look at your 401k provider, read through the prospectus and see what ETFs or what mutual funds they have put you in. Because quite frequently, the mutual funds that you have available to you in a 401k generally carry higher fees than normal. The good news is this XEQT fund, about a 0.2%. So less than 1/4 of 1%. That's relatively low. I would say it's very low. So we're okay with that. That's fine. At this point, I would say you're fine. The big risk that you have is that you are exclusively in equities. Now, the second part of the question here is I'm second guessing if this is truly the best, safest path. Is XEQT a solid choice for someone like me starting from near zero, or should I be looking at more U.S. concentrated options like Canadian equivalents of SPY, which is VFV, or QQQ, tech heavy, for potentially higher long-term returns? Well, remember, that last step we did broke down those markets, and you actually already have tremendous exposure to the U.S. market. I would argue that a majority of your portfolio is U.S. equities. We could look at that again. If I break this down, you have 21% plus another 20%, and then who knows what's in this 26. So at least 40% is direct U.S. equities. And my guess is taking some of this iShares Core Fund, you're looking about another 15%. So I would say you're probably running close to 55-60% of your portfolio, and this is U.S. equities with a heavy weighting towards the large cap tech. Is that good or bad? Well, again, we're spinning. We should not be spinning. No spinning. Huh. I hope you're not spinning. It seems okay to me. I've got no red flags on my end. All right. Thanks, Big Eb, for that vote of confidence. Refresh, Lisa. Refresh. So at this point, I think you're okay. I don't think, as you see here from your question, I don't think you need to diversify into U.S. ones. The bigger question is, should you diversify into other markets, which I'll get to in a second. So the next part of this question, which I bring it up here, he says, does it make sense to add precious metals, ETFs, for diversification if the main strategy is long-term equity investing and the investor already holds physical gold and silver? Well, if you're already holding physical gold and silver, I guess the question needs to be what allocations, right? What percentages is your portfolio in those markets, right? If I bring up my little holder here, it says, should you diversify? Again, not being a financial advisor, I can't give you financial advice, but it really depends on your risk tolerance. When you have your portfolio in one market, stocks, that does pose a risk to you, especially when you look at what the equity markets have done. There you go. Thanks, Dan. I actually, looking at the numbers, I would venture to say that even though that might come directly from their site, if you look at the numbers in there, it's more than 45% US. It's got to be. It has to be, just off the allocations that I saw. But either way, it's all equities, right? So let me show you some diagrams here of what I'm thinking about with regards to diversifying into metals. So if you look here, these are historical models of how financial advisors would typically boilerplate you into a portfolio. And you can see on the left here, I've got aggressive growth, which is 92% equities. The rest is 5% fixed income, some alternative investments. And as we become a little bit more conservative, you notice that the slice of the equity pie starts to shrink down a bit. It goes from aggressive growth to moderate growth, income and growth, and then the ultimate on the hard right edge there is the conservative portfolio, which still has 17% equities, but 76% fixed income bonds. So I guess the question for Darcy is, where do you think you fall here? You have mentioned to me in the email that you're saying, I got about 20 years left. Okay, I don't think there's any need to be putting yourself in the conservative category. Conservative, from my perspective, would be you're now in retirement and you need to protect that capital, therefore you're going to go heavy on bonds. I would argue that you're probably in one of these first two, which is aggressive growth. That certainly would be in your 20s and 30s. The growth side of things, I would say, might be your 30s to 40s. Moderate growth would be 40s to 50s. So I'd say, for me, I would target more that growth aspect. And notice what it says. It says you should be 77% equities, 19% fixed income or bonds, 2% alternatives, and 2% cash. Personally, screw that. Move the 2% cash into something else. Lisa says, I hope I have 20 years, but I will be retired in a few weeks. Hey, congratulations. We should have a little party for you, Lisa. Congratulations on retirement. Yay. So, Darcy, I would look at this not as a model that you need to jump into, but something to think about, right? It's already telling you you should have some exposure to bonds. And my big concern with starting right now, right? That's the big question. Is now the time to start dollar cost averaging? Granted, you have 20 years, but I'm also a firm believer in market timing and understanding that markets have waves. They have cycles to them, and it's our job to kind of understand what those waves look like and try to time these as best we can. So let me bring up a weekly of the equity markets here. Actually, I could probably just do this with a monthly to make it look long term. My only concern is, and I hope Oliver's not here today, so he doesn't pick on me, but I know he will because he's here, but it's okay. This is a monthly time frame. Let me get rid of these big drops. I don't know what I drew out pictures here, but I just want to show my favorite picture, which is the S&P 500 going all the way back into 1992. And I've mentioned this many times before, where you have these two drops that happen historically, and they look blown out of proportion right now. Unless I zoom in, it looks like this giant double top, right? Massive double top. Again, these are the financial crisis and the dot-com. Dot-com was down 50% on the S&P. That was from 2000 to 2003 or 2002. And then you had from 2007 to 2009, you had the financial crisis, which dropped the markets 57%. And those are two of the biggest crashes we've ever had. But when we zoom out, it is a bit scary seeing how much the gas pedal has been pushed on these equity markets. So what concerns me is you're looking at starting this process of dollar cost averaging at the highest levels that the equity markets has ever been at. Is now the time? It's a very difficult one to answer, because me, myself, I'd be like, you know what, I will actually hold on to some cash and stockpile it, wait for the market to sell off a little bit, maybe even 5%, 10%, and then buy in at a discount, because it just feels like we're getting a little bit frothy. You can see that sideways action we've had here for about the past 5 months. When I look at this on a daily time frame, actually, let me go to the future side. You can see we've been stuck in this little range-bound market, which is not good. We've been in a period with these equity markets, it's been nothing but up. And now all of a sudden we're starting to see a little bit of weakness here. So a couple different ways that I would approach this personally. If I was thinking that I want to start building a long-term portfolio right now, when the market is at levels that are highly elevated, I guess it depends on the tools that you have at your disposal. It sounds like you automatically are just taking withdrawals from your account for $150 out of each paycheck and buying XQ, whatever that one was, whatever the ETF was. If you have the ability to self-direct, what I would do personally for me is I would do the wheel strategy. I would be selling puts, cash-secured puts, and promising to buy this market if it starts to drop. That way I know I can buy it lower and collect a rate of return that will at least start to grow my portfolio. If you don't have that ability, or if you just want to, just not manage your portfolio and continue to let it go, just forget about it for 20 years, then sure, I would say start dollar cost averaging. just know that over the over course of time, you are going to get some pullbacks. So don't be glued to your portfolio performance. I mean, if I do my math correctly, I think you're putting in about $3,900 per year into this investment fund. So obviously over 20 years, there should be a good amount in there, but it could very easily happen where this market does drop 20 or 30%. I mean, over 20 years time, I would say that out of 20 years, you're probably gonna have at least 2 years that are significant down years. And market timing certainly would be beneficial to hold off and buy after those falls, or get out as they are falling and buy back in at lower prices. So all in all, to Darcy's comment or question, I do think now would be the time to do it, especially if you are hands-off. If you are more hands-on, I would build a cash position and maybe start selling cash secured puts and buy this market a little bit lower. Or I would be maybe buying this market right now and selling calls against my position to get a higher rate of return over time. So those are the 3 ways I would go about it. If you're going to be hands-off, which it sounds like you are, Darcy, then I would just throw your 150 in every 2 weeks. I think the vehicle that you have is fine as long as you have some physical gold. When you start to build those portfolios that you see here, what happens is you're no longer going to get the outright gains of the equity markets. So you look at that growth portfolio. Let's say the equity market rallies, 25% this year. I'm just making up a number. Please don't hold me to that. But let's say the equity market rallies 25% this year. You're not going to get 25% rate of return in this portfolio. Why? Because you got 19% in global fixed income. You'll be buying things like 10-year bonds, which is going to get you, 4%. So that's going to weigh down your portfolio. However, if the equity markets drop 25%, you're not going to lose 25% because you'll have the growth portion here of bonds and equities to help balance that out. So, the more you throw bonds in the mix, the more you mute the rate of returns on the upside and the downside. And I think that that's something that you definitely want to take into consideration as you get older, nearing retirement, but you got 20 years left. I'd be more on the aggressive side. What'd you say there, Big Ed? If it's long-term, it should be aggressive. I agree. And that's why I said if he's got 20 years, personally, I wouldn't put any bonds in there right now. I would be more inclined to keep it in the equity side of things. I may look to, if it was me, I would probably have a broad market ETF, like the SPY. In this case, the one he's using is fine for Canada. But I also like specific market segments, and I would be looking at those segments to buy an ETF that specifically targets, let's say, semiconductors or a nuclear energy segment, which are areas I'm interested in, or space. And add those in. Just know that those typically will be more volatile because you have a smaller subgroup there. But that's how I would build mine out. I personally wouldn't have any bonds, and I would manage my portfolio. I'd set stop losses as well. I know long term you shouldn't have stop losses. You're just going to hold it forever. But in the long term stuff, I do, especially in a situation like this. When you have this market teetering on the sideways cliff here. If it does start to fall, probably the best thing to do would be to get out of there and buy back when this thing drops 5, 10, 15, 20%, whatever it ultimately will fall, when and if it falls. Steven says, is there an ETF they could buy that could sell cash secured puts? Yes, there are ETFs out there. I can't remember the name off the top of my head, but there absolutely are ETFs that are doing basically the wheel strategy. They're selling options and collecting premium on them. I can't think off the top of my head. I have to dig into that one, Steve. And Marcia, earlier you asked a question about this. Let me make sure I get to it. He says, does dollar cost average reduce the risk? I was taught that it does. It doesn't reduce the risk overall. What it reduces is market timing risk. So if you hold off buying something today because you think that it's expensive and it keeps going up, you miss the opportunity. However, if something starts to fall and you buy today and it falls another 10% and you buy some more, now it doesn't have to go back up as far for you to break even. So dollar cost averaging reduces some elements of risk from long-term investing and price fluctuation, but it doesn't reduce risk overall, right? There's many different components of risk. That's one of them. So dollar cost averaging does eliminate some or reduce some risk, and that is the time and long-term decay and movements of price. So if you get something that falls 20%, you're like, oh no, this is terrible. Well, you've bought some more when it was 20% lower, so now all it has to do is jump up a little bit and break even. So there you go. Let's see. We got any Bond ETFs can lose when price moves down. He should make use of Treasury Direct and buy individual bonds. If he wants to, protect and have a little bit of little more stability in there, yes, he absolutely could be using Treasury Direct to buy bonds, but he'd be out using Canadian market. So there's a different market up there altogether, which I'm not familiar with the Canadian bond market. But yeah, you could buy bond funds as well. Yes, the bond funds do drop in value, but typically when they drop in value, because they're getting bonds with higher yields, so you'll get a higher rate of return of the bonds, but the bond fund drops because the price of bonds declines. Isn't that what there you go, yield max, that's the name of it. Yep, thank you, Liz. I could not think of the term yield max. So there are funds out there, they're called yield max, and that's what they do. They are basically a wheel strategy, selling options, collecting premium. The only challenge I see with those is you're somewhat limited on upside gains. If you had a huge move up, sometimes if you're doing covered call strategy, those shares will be taken away from you and you won't get the gains above. Kind of like what's happening with my Coinbase today, right? We'll see what happens tomorrow. Also, those yield max have a higher fee structure. The fees that you were using for your ETF in Canada were 0.2%. Yield max is going to be significantly higher than that. And what about reinvesting dividends or capital gains in an ETF? So depending on how that is set up with your broker, dividend payments may be auto-invested. Most of the time, it's just going to go into a cash portion. It sounds like Darcy is manually doing this. So what would have to happen is Darcy would have to go into his account when he has enough, take the interest payments, and then buy some more shares. Because it sounds like he was doing it manually. Marcia, for me, I would say having reinvested dividends is good. If you know it's long-term, it's the power of compounding, right? If you know, and these are paying interest, by the way. So there is, the S&P does pay interest. I'm not sure what the S&P pays off the top of my head, but you might get a couple percentage points worth of interest per year. Great. Take that, reinvest it. You can buy more and therefore build yourself a bigger position that compounds over time. I'd rather do wheel strategy myself than touch a yield max fund. I'm there 100% with you, Liz. That's why I enjoy doing it. I love doing the wheel strategy myself, but some people don't understand how to do it. They don't want to learn, and they'd rather just hit a button and let them do it. So that's why those funds exist. All right. So that answers my questions from Darcy. Darcy, I know you don't watch the show live, but hopefully that answered them for you there. You could absolutely add different markets to this. You could add some commodities. You could add, I know you don't have GLD, but you mentioned you had PHYS, which is the Sprott Gold ETF up there. That's fine. I looked into that one too, and you have a 0.42% fee structure for that one. Of course, Mickey's going to try to get you to buy STRC so you can get your 11% per year rate of return guaranteed. I would not recommend that you do that for the long-term part. Could you put a piece of your portfolio, let's say 5% in that? Okay, sure. But I would shy away from very speculative products that have the potential to take big losses. By being diversified with the funds that you're in, you're giving yourself a much safer approach to the market. So one wrong move and something like STRC could be toast, Mickey. Not that's going to happen, but it could happen. And the probability of the S&P having a massive decline is much, much less than STRC or MicroStrategy breaking up. As soon as the robots hit those buttons, soon, let them trade for us, right? Okay, so hopefully that helped some people out there. Again, this is a lot of thought that you're going to have to do on your own. And when you go through it, these are your considerations. What are you investing in? Make sure that you understand exactly what it is that you're buying into. You can take those ETFs, you can break them apart, look at the components and see where you have overlap. Most people in their 401ks and IRAs have significant overlap. They're mainly going to be in U.S. large cap equities. That's just the nature of the beast. Should you diversify? That depends on your objectives, what your goals and your risk tolerance are. In this case, Darcy is fairly aggressive because it's 100% equities. However, I don't think that that's that bad of an idea, particularly because you have such a long timeline. And if you're starting now and it does drop a lot, well, you may only lose, on a few $100s because you don't have a lot invested yet. And that brings to the final one there is now the time, and now as good a time as any, right? Just know there is a market correction and possibly crash coming. When? I don't know. but the markets always go through a boom-bust cycle. There's always a big market drawdown. Most of the time, nobody sees it coming, like the dot-com era or the financial crisis, and who knows what the next one will be. Maybe it's an AI bubble, maybe it's a crypto systemic crash. Who knows what it's going to be, but we will get a point in time down the road when markets drop, let's say 50%. Hopefully, they don't happen right as you go into retirement. If it does, I hope that you went to a much more conservative portfolio or in 75% bonds to dance around that one. All right, sun can come up in the west too. Not likely. That'd be weird. I kind of would be cool. I'd be fine with that. You know why? Because my bedroom is on the east-facing side of the house, and that sun gets in there bright and early. I don't like mornings. All right. That should do it for that part there. Let me run into what happened out in our equity markets today. And if you have questions, feel free to type money, and I'm happy to go over stuff, as you know, but I will be wrapping up here shortly just so I can get to my dentist in time. Tiny Tim says, I'm betting the crash will happen soon. It feels like it, but man, as John Maynard Keynes has said, the markets can remain irrational longer than you can remain solvent. So until we get confirmation, you got to stay in the direction of the prevailing trend, which in this case is long. Now, again, I've got this yellow box in here for a purpose, because to me that is a pretty important window of price. And if we get a close down below, we've tiptoed below it a couple times over the past few weeks, right? We certainly have a tiptoe down below this, and that means we have blown through some existing demand that may be laying in there, or that may have been in there before. Marsha wants to know, when's the last time we were in a situation of consolidation like this? Well, there was a bit of consolidation back here back here for the podcasters. I'm looking at like November of 2024 through February of 2025, and it did have a pretty significant sell-off. But there was another period back here where it went sideways from April of 2023 into May. So you had a full month of just nothing, and then all of a sudden it screamed to the upside. So, but in that situation, look at where price was coming from. The probability was higher it was going to break to the upside when it did after that consolidation, because that's like almost like an ascending triangle, right? What else do we have? Any big? I remember a couple years back we were doing the show. We were looking at the Russell 2000. Man, that was a good one. Let's go back. It was actually IWM. I had it mapped out for Tom, who was like at the time he was the big. There you go. Look at this one. This one is crazy. From 2021 all the way. That's from February of 2021 to right around October of 2021. So almost a full year. The Russell just did nothing. It just bounced sideways, and then it had like a breakout, and then started to fall apart. So I don't know. I just think that the markets are just long in the tooth. But I've been saying that for a while. I sound like a broken record. And even though I sound like a broken record, I'm still doing fine in my trading. It's just I hope that when the market does break down, I'll be ready and I'll have positions open to the short side. But it's looking decent. Big episode. The S&P is down less than 1% year to date. Why are we talking crash? Right? It's not that bad. Right now we're still okay. We're not talking crash. We're saying something might be coming. Now remember, as goes January, so goes the rest of the year, right? So we should be much higher than this, based off the January effect. But yeah, I'm going to go with what Wolf says, which is trade the chart, not what you think. Exactly. And that's why I'm saying if I get a close down below this yellow box, which is 67.71, we talked about it multiple times. If we get a close down below that, that doesn't mean I'm going full on ballistic, everything short. But I'll probably go into protection mode on my long positions, try to close those out as quickly as I can, and start building some short positions if that happens, and we'll get there. I remember there were a lot of people, Candle Swinger. We talked about that week after week after week after week on this show. It's like, man, the goose that lays the golden egg just going sideways for anybody who's doing spreads. There's always something coming. Probably get a 10% drawdown at some point this year. Buy it. A 10% off the all-time high. We've already drifted down a bit. Let's go to the peak here that we had back on January 28th. And if I go down 10%, bam, bam. Come on, Merlin. You get on 10%, you're looking at a market decline down around 6,300. 6,320, 6,330, somewhere in that ballpark. And even if I just shorted on the close below 67.71, that still gives me about 400 points of downside movement. So there you go. Isn't your controlling swing the lower? Yeah, you would say it's definitely this one here. So I'll put a line on that one too. That's the more significant number. But remember what I said. I'm not saying that if we get out of this yellow box that it's now all hell breaks loose and we just crash. That's not what I'm saying. What I'm saying is the first time we'll see it start to kind of make some new lows. So if it does, yeah, then I'm going to be targeting the 65.25 level. After that, then it's break out the short guns. You're looking at much more downside movement. But that's a long ways away from now. We'll have to wait and see how that all pans out later. But what's going to drive it up? War. War is good for equity markets. I think that later on this year, the discussion is going to increase about inflation. But who knows? Right now, it's just continue to stay long, try to collect some premium. I'm trading more volatile stuff, that's for sure. It's a little bit wild. What are we in at with Coinbase today? I really hope this drops down more. I'd like to see this thing close down below 192.50 tomorrow, but I'm not sure if we'll get there. It's still a long ways away. It's $13. What do I got? Tesla. Tesla's slightly down today, no big deal. And then CoreWeave. CoreWeave had a pretty big down day, but I still think I'm fairly safe on my $71 strikes. But anyway, we'll see how that goes. Okay, let's go to our top 8 here, and then I will wrap this up so I can go get my teeth scraped. Oh, I hate the dentist. All right, so Bitcoin. Bitcoin today down 2.61%. We mentioned this yesterday on how it has this breakout of that range, which is great. It's important, but we came right back down into it today. Ideally, what you'll see is it drop back down to somewhere right around 69,000 bottom and then start to make a new high. If that happens, then, okay, we'll probably head back towards that downtrending blue line, but I'm not convinced that the bottom is in. Yeah, I do. I saw that Broadcom did hold up well today. I was looking for a short opportunity. I'm like, no, I'll hold off on that one too. Russell 2000, you had a 1.9% slide for the Russell. Not looking good. Okay, we challenged those lows that we've kind of been bouncing off of this year. This whole year, we've kind of been bouncing off those lows right around 2560, 2570. Today, you can see that intraday low on the Russell 2000 hitting 2,559. All right, so getting a little bit weaker. The highs are getting weaker, so we'll keep our eye on a Russell here. Do we come back? That yellow box is done. I don't need that yellow box. That line can go. So the only line there's two that I would be looking for. First one's going to be 25.16. The next level will be 24.76. All right, gold is down 1.09%. Technically, I got nothing to really talk about here. There's no big story to be told. S&P 500, same thing, kind of choppy. What I find interesting is every time it sells off, it has a pretty significant rally back up. So you can really see that 67.71 mark acting like a bounce point, almost like a springboard. Every time it gets there, it rips up. Except, a couple days ago we broke below it, but also came ripping back on this one. So the buyers are certainly the ones that are winning the end of day. We'll see if that ends up changing here soon, but right now it's still holding those levels, which is a positive sign for anybody who's bullish on these markets because people are bidding it up. NASDAQ was down 0.31, nothing to speak of here. Chart doesn't look that great. Dollar index, though, tailed up again, big time up into that 99 level, 99.50. Man, same thing as the equity markets, but the opposite. It's upside down. We're just going right up into those overhead supply levels and bouncing back down. So decent move. It's up 0.27, but still muted. Your yields continue to surge. I mean, this might become the bigger story here. Is 4.14%. We're up 1% on the yield today on that 10-year bond. I was really expecting and hoping that this would drop lower because that means more economic growth, housing market boom. The higher this goes, the more it's going to slow that one down. And finally, crude oil. Bam. So my belief after we had this first big update on Monday on the war beginning, I thought we'd see a little bit of a downside movement and then continue this uptrend up. But boy, we just went skyrocketing today. 8.51% jump up in crude oil. $81 is where we closed at. And looking at levels, like where this might be headed, we talked about this the other day, kind of that 78 level would be the logical. Well, $70.50 is the logical target, but you can see it stair-stepping up and just blasting through overhead supply out there. Yep. Did it? I did. That would make sense. And look, if you're Iran, why wouldn't you? At this point, you got bombs raining down on you, and they're sinking every boat. This is where in like a fight, when the opponent gets scared, the gloves come off. This is where, in my opinion, things get dangerous. And stupid things get done when someone's in a total panic mode and they're being attacked. So hopefully it doesn't escalate from there, but would not surprise me at all that they're hitting tankers. Honestly, I don't know why there's any tankers still anywhere near there. Just get them out of there. Move them. What do you do when the dollar supply zone is broken? It adds more bearishness to the equity market. The stronger that dollar goes, the more likely you're going to see the equity market start to sell off. So I'm using that as almost a precursor to the equity market selling off. So that's how I would use it. Exactly, Wolf. There's no offense. There's no way. There is absolutely no way that Iran will beat the U.S. military. It's just not going to happen. I don't care what. It's just not going to happen. It's impossible. Not impossible, but it's just not going to happen. So, yeah, they're just hitting everything. They're just flailing. They're flailing out there. And that, again, that's when it's dangerous, right? Because there's not a lot of concern for the target. It's just going after anything to create as much chaos and destruction, which is what we really don't want. But they call us the great Satan. They will surrender to the devil. Well, it may not surrender, you know. Hopefully, when you remove the radicals and cooler heads prevail, maybe it's not a surrender. Maybe it's coming to an agreement, right? We can position things so it doesn't sound like when you say surrender, I don't know. I think that there's diplomatic ways we could resolve this and we could get peaceful resolution. But for right now, it's just going to create chaos in our market. So I'd be particularly careful with your positions and how you allocate them because it's wild out there. I thought this would be over quick, but I see a guy on the news say Iran could make this. I think it could go on much longer than people anticipated. But with the barrage of attacks we have, and I don't know if you guys are fans of Jon Stewart or not. I'm a fan of Jon Stewart. I like his cynicism. I like his approach. But he had some pretty high-level people on his program the other day. And I don't normally watch him. It just kind of came across my feed. And they were really impressed with the precision of our attacks, like how meticulous the detail of the U.S. and the Iranian forces have been on strategic targeting of targets in Iran. Great, but not a lot of thought as to getting everybody out and to protecting everybody. Looking forward to trading the Iranian markets in 2027. There you go. Yeah, he's a smart man. He's, some people hate him. But that's the same thing. There's a lot of people that don't like me as well. So, you can't win them all. But yeah, I'm a Jon Stewart fan. I think he's got some pretty interesting perspectives. All right, let's get off the politics and move over here towards economic stuff. So we had unemployment claims today. Let me scroll back up here. You had unemployment claims actually came in line with expectations. With the original number. Expectations was we were going to jump. So this is good. This is a good piece of jobs data. But tomorrow is really the big day. All right. It does feel good that we have these two low levels here at 213, but they are starting to show increases. Here's the problem we have for tomorrow. For those of you that trade in the morning, you have 1 hour before the equity markets open. You have average hourly earnings. You have core retail sales, non-farm employment change, and then drum roll, please, the unemployment rate coming out. Right now, expectations are that unemployment rate is going to stay at 4.3%, which I don't know. My gut tells me we'll come out slightly higher, but what the heck do I know? What do I even believe this data? But right now they're saying that the unemployment rate will stay the same at 4.3%. What we want to be careful of and be mindful of is what happens if this starts to continue up, and how do we read it if we see it deviate from 4.3? For example, if it comes out, let's say 4.2 or 4.1, that's a sign that the government or that the Federal Reserve has room to cut rates even further, right? If an unemployment rate so they could raise rates technically without hurting the jobs market. If unemployment is rising, they'd be wanting to cut rates. So if unemployment rate falls to 4.2, 4.1, there may be a bigger discussion about them holding longer and potentially raising. If unemployment jumps to, let's say, 4.5, then it's, the Fed needs to cut rates to stimulate job growth and get the market going. So again, these numbers, whether you believe them or not, are definitely drivers of what the Fed is going to do. I believe we looked at this the other day, and the Fed has a significant chance of keeping rates the same at the next FOMC meeting, which I will bring up for you right now. Yep, I'm with Stephen. You've heard me say that many times. Anything below 5, I think it's been so long, my brain has too many numbers in it, but even Ben Bernanke said 5.5% is full employment. Full employment would be 5.5%, and here we are down, freaking out about 4.3. We're fine. Yeah, I shouldn't be worried. So right now there's a 97% chance that meeting on March 18th is going to be a nothing burger. No raise, no nothing. Their April meeting, still no change. June, still no change. So this is interesting. Let's go to December and see. Right now, June is forecasting one rate cut. December. We go all the way out to December, only 1 rate cut. Remember earlier this year, it was 2 rate cuts. Now all of a sudden it's 1. So the tide is slowly shifting towards maybe no rate cuts this year. And if things start to get bad, you might even see a rate increase, which, I don't know. We'll worry about that one down the road. Okay. So let's see. Fed will not do anything, just too many. I agree. Honestly, it's what they should do. They shouldn't have raised 3 times, but it's done is done. They'll probably rest on their hands, and as they should. Okay. Earnings. We had Costco report earnings today. Let's go jump out and check out COST. Yeah, March says, when will the higher oil prices cause more inflation? It already is causing more inflation, but when does it hit the inflationary numbers, the core PCE, et cetera, right? When does that stuff come through? That, to me, is much more important, is when does it actually hit the end data? And we haven't seen it come through yet. I think that your next readings will be the print out there where we'll see more pop up in inflationary data. So here is your Costco wholesale. They reported earnings today. $4.54 is what they were estimated to make. They came out at $4.58, so they barely beat, but they're down. They were down 2.4%, now down another just slightly in the after-hour session here. I'll show you the 5-minute time frame for Costco. There you go. So nothing too dramatic, even though they beat earnings. From the earnings calendar, though, we do have more for tomorrow. Let me bring up your Friday calendar here. These stupid ads go away. Your misleading ad. There we go. All right, so for Friday, do we have anything important? No. Just scrolling through here, seeing if there's any big names I could recognize that might be impactful. You have Vista Gold, but these are all super, super tiny companies. So I'm going to say nothing on the front for Friday's session. I have a small change in plans for Friday's shows going forward. As you know, I'm usually toasting you with a glass of whiskey. I am not drinking at all until March 27th when I do my DEXA scan. No beers, no seltzers, no whiskey, straight sober. Trying to get my body fat down under 15%. We'll see if I can do that in the next 4 weeks' time. So I will have a glass of soda water with you on tomorrow's show. Don't want to leave you guys hanging. Costco should raise lunch deals. A hot dog and chips and a Coke for $2. Hey, Steve. Don't make me block you, but don't start spreading rumors or try to get Costco to raise the price of that hot dog and Coke. That's their bread and butter, buddy. Don't do it. Don't do it. I don't want to see it, even though I don't eat them anymore. They've had that forever, and it should stay that way. I mean, I love the fact that they have not raised the price of the hot dog and a Coke. It's awesome. It's a lost leader. You know, there's so many people going to that food court just to eat hot dogs and stuff. It's unfortunately, that hot dog and a soda is not good for you. It's not healthy. Yeah, thanks, Dan. I wish it was just a toothbrush. Unfortunately, what I get is the little machine that's got that grinder on it, which I'm not excited about. Cucumber infused water. I'm not a big fan of the cucumber, but I do like these Waterloos or the Buble. There's certain ones I think are just much easier to drink. I do like the seltzer waters that are just straight. Dry Merlin, you will sleep so good. Lisa, with all the information and the way that my brain thinks and the way that my brain functions, the alcohol is not my worst. It's not my worst enemy. The Costco fast food jug will kill you. Yeah. It's interesting. You got to take care of yourself. And I had a friend. I got 2 minutes left. I have a friend. I will leave her name out of this, but she ends up getting very depressed, and I think she's depressed because she's heavier, and she just gets frustrated about it because she's not meeting anybody. And she posted a picture yesterday on her social media where she had, and I'm not exaggerating, like 3 pints of Ben & Jerry's, like an ice cream cake, and a bag of M&Ms, and it was like, I'm treating myself because I'm depressed. I'm like, honey, it's like Austin Powers, right? The movie, I think, remember the character's name is Fat Bastard. And I'm fat because I'm unhappy, and I'm unhappy because I'm fat. It's like, then take care of yourself. Eat better. Eat healthy. You'll feel better about yourself. Your body will feel better. You'll have less health issues. It's a spiraling thing, but we all have to take care of ourselves. Yeah, absolutely. Anyway, my vent is over. So, Darcy up in Vancouver, thank you very much for the question on your dollar cost averaging. I hope I answered some of your concerns. If you have more details that you would like, answered, feel free to send them on in. And that goes for everybody here. You know, most of the regulars don't send in questions via email anymore because you just type them in a chat. But if you do have questions, email me at email me at tradermerlin@gmail.com, or put a comment down below any of our YouTube videos, and I will get to those on tomorrow's show. It's Friday, should be a good one. I'm looking forward to the closure of some of these trades I have open. I'll definitely let you guys know what happens with that, and maybe I might even roll my Coinbase position forward and not get out, but we'll see what happens tomorrow. I'll let you guys all know all those details tomorrow. So email me, let me know if you want something discussed tomorrow, and I will see you on Friday. Take care, everybody.